Welcome back to the Algorithmic Advantage, everyone. So happy to have you here. It's the 3rd of October, 2023. Thank you for subscribing, for liking and following on whatever platform you're on. Please don't forget to visit our website and sign up to the newsletter. That's the best way to stay in touch and know when new shows are released. You could also provide us any feedback there if you wanted. Today, I'm super excited to present Marc Malek from Conquest Capital Partners. You could reach him or visit the fund website on conquestcp.com. Marc has a phenomenal track record that stretches back to 1999, and a track record that long is difficult to argue with. Marc has decades of rich and diverse experience in the industry, and we dive into so many topics, including short-term trend following, logic and behavioural-driven models, and much, much more. I really enjoyed his comment that a strategy should be able to be described simply to any reasonable person in a few minutes, or he's not interested in it. We talk about diversifying strategies, all-weather portfolios, surviving and thriving under different regimes, being different to the pack, what he brings from his past experience in running complex derivatives operations in big banks, dynamic portfolio, adjustment, and even replication. So there is a lot in the show. Let's get into it.
Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field. We hope you enjoy the show, and if you do, please subscribe, leave us a review, or even buy us a coffee via the link on the algorithmicadvantage.com. We really appreciate it.
Welcome, Marc. We're really happy to have you here, excited to do this show. Rich, welcome to you as well.
Thank you, Simon.
Thanks, Simon. Hi, Marc.
Hi, how are you, Rich?
Very good.
Let's launch straight into it, gentlemen. Marc, we are, as I said, very happy to have you here and chat about your trading, your history, your research. You've had so much to offer in this field. You've been a portfolio manager for quite some time, which is fantastic as well. I would love to know a little bit about your background, obviously, at a high level, some of that professional experience that brought you into trading, into the markets, what got you here, and with that extensive history you do have, I am actually interested in some of one or two of the highs and lows of that period, and maybe even at the end I'll ask you, if you were going to do it all over again, what might you change? But give us a high level overview of what got you into the markets and brought you to where you are now.
Well, Simon, growing up, this was definitely not something that I thought I'd ever be doing. I'm originally from Beirut, Lebanon. I grew up during the civil war in Lebanon. And talk about sometimes certain events happen and your life takes a certain direction that you never had envisioned before. In my case, I'm almost ashamed to say it, but when I was 17 years old in Beirut in the middle of the civil war, everybody had guns and they were playing with the guns. And one day while I was playing with the guns, I ended up shooting myself. I'm holding the gun in my hand, and it was one of those hot Beirut summer days, and I'm chambering a bullet, and the bullet comes out and goes into my finger this side, out this other finger, down into my leg, out the other side. Needless to say, my parents were not happy with this at all. My dad had a construction business in the Gulf. He flies into Lebanon. My family hides me at a summer resort, so nobody can know that I shot myself. My dad comes in and he says, you know what? You're not staying in this country. I wasn't even, I was, 1 year in my, 1 year, junior in high school. I was in the French baccalaureate system. So I was, first part of the baccalaureate. My dad gives me an option of, you can go to France to continue, or you can go to the US. Having gone through to the French lycée system in Lebanon, I could not stand to be in the French system any longer. So I chose going to the US. I went to the US essentially thinking I was going to study civil engineering and join, the family's construction business. I went to school at Caltech, and when I got to Caltech, it was the beginning of the whole artificial intelligence neural network era. And I got fascinated by this whole thing. It was really the beginning of it back then. We're talking in the late 80s here. Caltech didn't offer a major in neural network and artificial intelligence. So I ended up, petitioning the registrar to sort of create my own major in it. In my junior year at Caltech, I got a grant from the Pentagon through NASA's Jet Propulsion Laboratory. So the way NASA operates in the US, they have 8 different centers: Cape Kennedy, Cape Canaveral, JPL is one of them, and JPL is co-run with Caltech. And the grant was essentially to use some of the new mathematical techniques I was developing to optimize the placement of tanks in a battlefield. Okay. When I went to the professor who was doing the leading research in that field to do my work with him, we're getting to know each other, and he finds out I'm from Lebanon. And he makes a comment that, I just came, he said, you just came from a battlefield. Do you really want to spend the whole term looking at tanks and battlefield? Whether you do green tanks, blue tanks, or red tanks, or whether you do stocks, bonds, and commodities, the math is the same. I frankly had no idea what a stock was, or a bond was, or a commodity was, but it seemed like fun thing to do. So I took him up on his suggestion. I remember I had to go to the library to check out a book, teach myself what a stock and a bond were. I did my work. I wrote a paper on my research. The paper ended up getting published at the university. Then, I was going into my senior year at Caltech. I was very excited. I was graduating at the top of my class. And as a result, I had the highest job offer in my class. This is, by then, we're talking 1992. So I had a job offer from Oracle to go to Oracle, essentially to work for a couple of years before going back and getting my PhD. The offer was, if I remember correctly, it was for about $45,000 base and $5,000 bonus. And I still have the offer letter signed by Larry Ellison. Back then, Oracle was small enough; he was still signing these letters himself.
Wonderful.
$45,000 base and a $5,000 bonus for a 21-year-old kid back in '92 seemed like a small fortune. So,
indeed.
I was flying high, and then, another turn, like, shooting myself kind of turn, but in my spring term, I get a call from somebody saying, this is so-and-so from Solomon Brothers in New York. We read your paper, and we'd like to invite you for an interview. Now, frankly, at the time, I had no idea who Solomon was, or his brothers, or Wall Street, or any of this stuff was, but I figured it's a free trip to New York. I had never been to New York, always heard great things about it. So, I said, why not? So I went to see Solomon, and I don't know if you guys remember, but Solomon in '92 was sort of the it firm. It had just moved to its brand new office space in 7 World Trade Center. And, you go in, and this is, Solomon of Liar's Poker type Solomon. You go in and you can't help but get sort of awed by the whole thing. And the same way, when I saw AI and neural networks, I kind of switched from civil engineering to that. And when I saw, trading and Solomon and Wall Street, I thought I had to do this. It sounds like way too much fun. Oracle can wait. I'll do this for a couple of years and I'll get my PhD. And I remember, while interviewing, talking to people, thinking in my head that they'll never meet the Oracle offer, but I have to do this. And sure enough, the MD called me into his office the second day and tells me, look, we don't do this often, but everybody really likes you, and I'm going to make you an offer on the spot. Which gladly, it was multiple of what Oracle was offering. So that was, at that point, I kind of sold my soul to I don't want to say the devil, but to Wall Street. And that was the beginning of my Wall Street career and the end of the academic one. I kept saying 1 more year and I'll go and get my PhD, and I still say that until today.
Yes, because it was more practical to keep trading.
Exactly.
And tell me, how different is the competitive marketplace to tank warfare?
Sometimes after my experience on Wall Street, I think it might be safer to be, a tank commander than a trader.
It would have actually been an easier career.
Well, you know what? It reminds me at some point to tell you, speaking of tanks and destroying things, I'll tell you the story about the day I broke the peg in dollar Hong Kong. That peg has never been broken. If you look at a chart of dollar Hong Kong, it's straight. It looks like, except for one day during the Asian crisis, it almost looks like a bad data point. But it's a good data point. It was yours truly. But that was as close as I got to Wall Street too. Yes.
All right. We will definitely ask about that. So when you got into Solomon's, what happened then? Because you've got some interesting career highlights along the way, I suppose, and particularly as it led toward you building strategies and managing money for yourself. What was the background there?
Look, so when, unsurprisingly, when I was hired at Solomon, I was hired in the research department. I was hired in financial strategy, which was part of bond portfolio analysis, which was the overall research team that was supporting the arbitrage desk, the guys that later became long-term capital, and some other desk at Solomon Brothers. Now, I didn't know much about Wall Street when I got there, but it didn't take me long to realize after I got there that I would much rather be on the trading side than the research side. So actually in '93, I ended up doing something that was almost never done at Solomon, which is leave the Solomon training program before the end. People thought I was crazy, but I wanted to trade, and it was going to take too long for me while at Solomon to finish the training program in research and then switch to trading. So I ended up interviewing for trading jobs. And I remember one day, a good friend of mine at Solomon, who was also interviewing for trading jobs, comes to my little cubicle, takes this Wall Street Journal and throws it in the cubicle. And he tells me, I just interviewed with these guys. They dinged me, but I think they're looking for someone like you. And it was back when the Wall Street Journal had the, ad like the wanted section, for jobs. And he had this job circled. And it said rocket scientist wanted for a hedge fund in Inglewood Cliffs in New Jersey. So I went to speak to them, and actually the trading partner in the hedge fund was an ex-Solomon trader who had been very successful at Solomon, was sort of known as the grandfather of currency option or the father of currency options, and then had left Solomon to go to Bankers Trust, where he had a very successful career. While at Bankers Trust, I think he broke the Kiwi. His name is Andy Krieger. He might be familiar with some of the guys down under, but he broke the Kiwi at some point, and then went on to become the head trader for Soros. Before leaving Soros and launching his own hedge fund. In 1993, he was managing about $500 million. So I ended up going to join Andy in his fund, And I went there to essentially trade currency options and build quantitative trading models. And that's where I built my first quant portfolio, which was a pretty simple long-term trend following strategy.
Right. So systematic roots, Marc. So
that's where it started.
Yeah. Yeah. What degree of discretion was in those models? Was it, discretion in the front end and then systematic through the application of the process?
No. So the fund was managing about $500 million or so, and most of the money was trading currency options. So I had one hat on where I was trading currency option, with Andy, him being the PM. But then they had gotten an allocation of $50 million from another client for the sole purpose of building a quant portfolio. So I built essentially that long-term trend following strategy for that $50 million portfolio. And, it was, as you would imagine, 50, 60 different markets, long-term trend following, trading by appointment, fairly simple. But that was really my first exposure at building a quantitative model or a portfolio.
And was that sort of more Turtle's approach to trend? What was that approach?
Absolutely. It was absolutely Turtle approach. Long-term trend following, moving average crossover, one long-term average, one shorter-term average, apply it on diversified set of markets and let it rip.
Gotcha.
What year was that again, Marc?
This is 1993.
Yeah, 93. All right. And then when did you break away, I suppose, and start doing your own thing?
So by 1994, the two partners in the fund I was at started having problems with each other, and actually, they were the firm looked like it was going to break up. Andy, who was the trading partner, was interviewing with other shops, and he was taking me along on the interviews. He wanted me to go with him wherever he went. One of those places was UBS. We had interviewed at UBS. He didn't end up getting the job there, but UBS called me up. He said, "You know what, you would like to have." Given that the firm seemed to have been going under, I accepted the offer from UBS. And frankly, the offer was something that, now that I think about it, seems kind of, well, anyway, it was, they wanted me to go over there to start and run their global group in exotic derivatives. Now, this is 1994. I was, 24, 25 years old, and exotic derivatives. I mean, only after I started building this group and warehousing the risk did I look back and say, what the hell was wrong with them putting all that in a 24-year-old kid. But you know what? It ended up being a great experience. I went there essentially to build the exotic derivatives group globally. So I started in New York.
Marc, what do we mean by exotic derivatives here? So can you just explain that for our audience?
Essentially any derivative that is more complicated than a simple call or a put. So knock-in, knockouts. The way I looked at it is, when you have a simple call or a put, there is no path dependency consideration. So at the maturity, you're either in the money or out of the money. Exotic derivatives allowed you to put path dependency into the payout. So you could say, I want a call on the Aussie dollar, 6 months, strike X, but for the first 2 weeks, it's going to stay below this level. For the second 2 weeks, it's going to go above that level. I mean, it's really, basically
so there's
anything.
Structure to the risk profile over the course of time.
You can define the path, and the more definition you put in the path, the cheaper the option becomes, because the probability of actually hitting that path almost goes to zero.
Okay.
So, so I built this group in New York initially. Then I moved to London, did the same. Then moved to Tokyo, did the same. Globalized the business, turned it into one of the most profitable units within UBS. And actually, it was during that period that I managed to break the peg in dollar Hong Kong. So, I'll tell you the story.
So tell us about that
now. But essentially, it was during the Asian crisis in the late 90s. I was short an option had this client who was known for really very predatory dealing with the street. Anyway, I won't go his history of why nobody liked this guy, but essentially he wanted to buy $1 billion. I sold him $1 billion of a dollar call Hong Kong put with the knockout on the option below the Hong Kong peg. So as this is before the Asian crisis, as the Asian crisis started happening, the hedge I had for this option, the hedge I had put on, realized the gain of over a couple $100 million or so. Now, I couldn't realize any of this gain in the hedge because it was against the option. However, if I could manage to knock out the option, then I can realize that gain. Now, the peg in Hong Kong had never been broken. So, what do you do? So,
what are the chances? Yeah.
What are the chances? Exactly. So, essentially, we came up. So anybody on the FX side knows that obviously the FX markets are open 24 hours a day. But for 1 hour in that 24-hour cycle, the markets pretty much go to sleep. It's called Tokyo launch. And you really have no idea of what happens. I always heard about Tokyo launch when I was in Europe or the US, but I didn't really see it until I was in Tokyo, where literally at noon, half the traders put their head down and take a nap, and the other half go for a liquid lunch. So I came up with
They're
this
not
idea.
at their best. They're not at their best during this period of time.
So I
Tank
came up with
warfare
this,
comes to mind.
So I came up with this idea. If I wait 15 minutes into Tokyo launch, so whoever is taking a nap is already dozing off. Whoever is, on his way to the liquid lunch is already a drink or two in. And then we line up every UBS trading desk around the world. And on my mark, we start selling. And we just start selling until we jam the market all the way into the peg. Now, I thought, it might cost us, $50, $60 million, $70 million to break the peg. But given the P&L in the hedge, there'll still be a pretty good day at the end of the day. Now, what happened is we didn't realize this until we started selling. But given that it was the Asian crisis, as we started selling, actually, there were a lot of stops that were in the market in dollar Hong Kong. So as we started selling, we started triggering other stops. Then the stops started running other stops. So it didn't take nearly as much as we thought it would take to actually break the peg.
So it all amplified.
We just started selling, and then the minute we broke the peg, it started accelerating because of all these other stop losses. And at some point, we just went and we became the bid for all these dollars, and then bought it all the way back up.
Wow!
Now,
what a trade!
Let's put it this way. That night, I took the whole desk at UBS Tokyo for dinner at one of the most expensive Kobe beef restaurant, and the bill was obscene. But I didn't want to expense that bill to UBS because I wanted to keep it as a souvenir. So I paid for it out of my own pocket, and I still have that bill from that day.
Oh, well, well done. Well done.
Clearly, today you cannot do anything like this. I mean, today that probably would be illegal. But back then, it was much more sort of free-for-all kind of market.
The Wild West. Yeah. I mean, it does sound, Mark, if I may say, a bit like predatory behavior against your client there.
Yeah, I mean, look, this client was plenty predatory himself.
Yes.
So nobody shed a tear for him. He was known for always trying to pick off every trader on the street. So got a lot of tears from the rest of the street when we did that.
He shouldn't have picked on a man who's already been shot by the time he was 17. He knows that.
Yeah, and has orchestrated tank warfare. Don't mess with him.
He messed with the wrong guy. Wow, that's fascinating.
Ancient history now.
Amazing. All right, well...
that was UBS. So where to from here?
So, I stayed with UBS until 1999, when, frankly, I was sort of fed up with the whole banking system and everything. And that's when I decided to leave the bank and start my own fund. Now, I was living in London. So I moved out of London. I went back to New York. I wanted to do my fund in New York. I took $3 million of my own money, set up a fund, and started trading. Now, the idea...
Marc, at that point in time, you obviously had firm views about how you wanted to start that fund, the philosophy, the trading strategy. What style was it?
Well, look, the idea for the strategy actually was born out of my own frustration managing my own money while I was at UBS, in the sense that no matter how diligent I thought I was at diversifying my investments amongst non-correlated strategies, that diversification always worked really well in risk-on environments. But then whenever you had a risk-off environment, all those investments started losing money at the same time. So my idea for the strategy was that if I can build a strategy that did really well when everybody else was losing and didn't lose when everybody else was winning, then it should be a natural fit in most people's portfolio. So the strategy from day one was a short-term trading strategy, average holding period about 10 days or so. The portfolio was largely financial. So from a risk allocation perspective, it was about 30% FX, 30% global government fixed income, 30% global equity indices, and 10% energies and metals. I deliberately did not want to include any of the other commodities in it. I mean, energies and metals are the kind of commodities that have a foot in the commodity space and the foot in the financial space. They move both with microeconomic data as well as commodity reasons. The reason for that is, given the mandate I wanted for the fund to do really well in these risk-off periods, if you add something like orange juice to your portfolio, for example, so orange juice could be a very profitable strategy using the models that we have. But orange juice, you can get a freeze in Florida and the damn thing can go limit up for, 5-6 days without any, regard to whether markets are risk on or risk off. So I didn't want to have that unknown factor into the portfolio. The portfolio has always been largely financial. When we initially started, we had 3 individual sub-strategies within Conquest, and each one of those sub-strategies was trading multiple models.
Can you just describe in brief the basis of those 3 models in Conquest?
Sure.
What styles?
It's 3 sub-strategies, and each one trading multiple models. So the first sub-strategy, we call it short-term trading long vol. That's essentially our shortest duration sub-strategy. And it's a lot of momentum, vol breakout type models. The second one
are
is
options in that, Marc, or is it?
No. Actually, we don't use any options. We only use futures and foreign exchange, OTC.
And Marc,
FX.
I was going to ask there as well. With your background in exotics, you weren't tempted, or you didn't see some opportunities there to take the extra step and get ISDAs and be able to trade OTC products and stuff in the fund?
I was actually. Well, this is where I got my first shock as a PM and not somebody who is working for a bank. It turns out that bid-ask spread are very different if you're the market maker versus you are a client. So strategies that made a lot of sense when you're the bank don't work as well when you're your client or the bank. Also, I mean, frankly, look, when I started in options back in 1993, options were inherently mispriced because people did not, most market players did not properly value options. In the sense that if you look at a Black-Scholes model that asks you for a single input for volatility, well, that volatility is not really a single input. Right? There is a term structure to volatility. And Black-Scholes really, doesn't give you the correct option pricing. So if you were somewhat, sort of quantitatively inclined, and you could build your own option pricing model that takes into account the term structure of volatility, you can pretty much, arb the market day in, day out. So this is in 1993. By 2000, by 99, 2000, with the onset of the internet and all of that, really you could just go and Google term structure volatility option model, and then you can. So a lot of the arbitrages that existed in the option sort of market back in the early 90s, by the 2000 they were pretty much priced out. So if options became, or volatility or options became properly priced, then buying options as a strategy at best is flat, and then when you put in transaction costs, it becomes a negative proposition strategy. So for us,
so back to your thing. So you had your short-term models. So that was one of your programs, but not in options.
We had to create models that do sort of use futures to do almost like option replication payout.
Yes. But and you make a very good point there, because trend following is not long vol, as you've mentioned that previously. But to get those short, sharp movements, you're in the short-term space with your long vol. That's one of your programs. What are your other two programs?
So the first one is, like I said, short-term trading, long vol. The second one is short-term trend following. That's fairly simple. I mean, we're doing trend following on sort of 10-day-ish, 2-week type horizon. The third sub-strategy is a very interesting one. We call it non-trend and counter-trend. It's essentially where we put in any model that is not short-term trend, that's not short-term trend following, or not long volatility type. So there,
anything that's uncorrelated but has the same properties. Yes.
So if you look at our short-term trading long vol component, all the models are positively correlated to each other, but under 50%. If you look at the short-term trend following, all the models are correlated to each, positively correlated, but closer to 50%. I mean, there are only so many ways you can skin the cat doing kind of 10-day to 2-week trend following. Our non-trend and counter-trend sub-strategy actually has a lot of models that are negatively correlated to each other. So it's a very interesting addition to the rest of the portfolio. Yes. Now, to go back to the question,
Marc, just before we go on, one of the key things I think you've said there is you're doing something that maybe 90% of the market isn't doing. So when we say 90% of the market, we're really saying, well, they're the people that apply those, negative skew strategies effectively. You're in the divergent space. Would you put yourself in the 10% divergent space that is counter position to the majority of the market participants with your models?
Yes. I mean, look, we occupy a very sort of unique space in the sense that because we trade only futures and FX, we're technically classified as the CTAs. So within the CTA space, we're maybe 5%. So our space is 5% of the CTA space that tends to be, by and large, long-term trend followers. And then when you put us in the context of overall funds management, then we're less than 1%, I would say, because we're doing something that is extremely unique, and especially when you look at our fund with the payout structure of our fund. I mean, there aren't that many strategies that actually are positive in both risk on periods and risk off periods. And by the way, we started with 3 sub-strategies, but along our history, we added a 4th one that helps us with that thing, but we'll get to that later. But yes, we do something that I think is very unique and is not, I can't think of anybody else who does it the same way we do it.
Yeah, I was thinking if there was any likeness that I've heard of in the industry, it would be getting more towards maybe Alpha Quest, the short-term momentum type of style of trading.
I'm glad you mentioned Alpha Quest, because the Alpha Quest founder and myself were old friends. And actually, when we started our business, we partnered up. We partnered up for about a year.
This is Nigol?
Yes, Nigol. I knew him from the early 90s, and he was working at a fund of fund in Western Connecticut called Western Capital. And I was running my history with UBS is I was running global derivatives, and then I was also promoted to run after UBS and SBC merged. I was promoted to run the combined banks prop trading groups in Europe and the Americas. So I was running prop at UBS, and Nigol was doing a fund of fund with Western Capital, and we thought it would be a good idea to partner up and have a firm that does both fund of fund and CTAs, and we both become partners at both, which we did. And a year into our new venture, we figured out that we're much better friends than business partners, and we went our separate ways. But look, AlphaQuest is a perfect example of why we are different. Because if you look at AlphaQuest's return this year, I think they're down about 15, 16%. It's been a pretty rough year for them. We're up a few points. But we have a correlation of 84% to them. So we have 84% correlation, and yet we have in 9 months, 15 points of alpha.
Yeah. No, it's interesting.
But you're right. That's the closest there is to us.
The closest there is, but it's still a long way off. Yeah.
Exactly.
So you're unique. You're uniquely positioned in there. And listen, with Universa, of course, which are offering tail protection, you're not in that game, are you, of tail protection strictly, are you?
No. I mean, look, our strategy is better at tail protection than, okay, so let me rephrase that. If you look at most tail protection strategies, whether you're looking at short sellers, which give you very good tail protection, or looking at pure long vol strategies, those strategies do really well in risk-off environments. However, in the risk-on environment, they lose money for so long that they become almost impossible for investors to hold them in between times when they make money. I have a lot of friends on the allocation side that tell me they buy these investments, and at some point they can't take it anymore. They redeem. Just after they redeem, these strategies start making money. So it's very different. I mean, what we offer in our case is something. I mean, look. So maybe I'll talk a little bit about the Conquest Risk Index and how that basically changed our profile.
I just want to give you a moment to now bring us up to the present and bring everything together, just so that we're not speaking too much about strategies that may have existed in the past. So why don't you just take a moment to talk about where you've landed now, and then we can further go into your philosophy and some of the research that backs up, what you're doing now.
Where we are now is, we're running the Conquest quantitative macro strategy, which has its roots at what we started with in 1999, but frankly looks very different. And it looks very different than what we started with because of everything that we've learned. I mean, we started in 99, now we're 2023. We've learned a lot along the way of both how to do things better, but also how not to do certain things. And the sum total of everything that we've learned is in the strategy today. So I think what we have today is the best version of whatever we had in the past. And it really is a very unique product that's much more quant macro than it is at our beginning root of a trading strategy or short-term CTA or so on.
Can you explain the quant macro bias now that's in your programs, where that's come from, and what it's dealing with for our viewers?
Sure. So let me give you sort of the quick version of the evolution. So we started off with 3 sub-strategies in what I call a crisis alpha strategy plus, in the sense that it was a crisis alpha strategy, but one that didn't lose money in the risk on period. So that's where the kind of the plus comes in. So our first full year of trading was 2000. We're up 45% in a risk off year. 2001 risk on year we're flat. 2002 was another risk off year. We're up another 35-40%. So we're having great success. And then, like all human beings, you get greedy. I was very happy with our performance in these risk-off periods, but I wanted to see if there was a way I can keep that performance the same, but improve it from an absolute value perspective in the risk-on ones. Now, for me to answer that question, I really needed to come up with a quantitative way of defining what's a risk-on environment and what's a risk-off environment. So we started that major research project in 93 that stayed with us for the next decade or more. And by 1994, we had built the Conquest Risk Index, which, to my knowledge, was either the first risk index out there or one of the very first few risk indices out there. And essentially what our risk index did, it looked at different pockets of risk in the market, from liquidity risk to credit risk to emerging market risk to FX risk to equity risk. It aggregated all these risks and gave us a daily and a monthly reading, whether we were risk on, we called it risk seeking, and risk off, and we called it risk averse. Now, when we built our index and looked at the statistical properties of this index, it says the world spends about 70% of the time, risk seeking, risk on, and about 30% of the time risk off or risk averse. Then we took that index and we said, well, if we look at markets overall, do markets overall show any statistically significant difference in their performance by risk regime? And here we probably looked at over 300 individual markets. And sure enough, about 85% of the markets we looked at showed a very strong statistical bias towards performing really well in the risk-seeking environment and very poorly in the risk-averse environment. Then we took that analysis and took it one level higher. We said, what about strategies that trade those markets? And again, here we looked at dozens of individual strategies, from public equity, private equity, hedge funds, real estate, venture capital, you name it. And we even found a higher percentage, so about 95% or more of the strategies we looked at showed a very clear statistical bias to performing really well in the risk-seeking environment and very poorly in the risk-averse environment. Yes. Then we took that analysis and turned it into our own 3 sub-strategies and dozens of individual models. And sure enough, 2 of the 3 sub-strategies that we had also showed that same statistical bias. So by 2005, it became painfully obvious to us that it's completely, we can improve our performance significantly if we go from a static risk allocation to the different sub-strategies in our portfolio to a dynamic risk allocation based on the risk environment, the Conquest Risk Index. So when our Conquest Risk Index said we are risk-seeking, then we trade a certain portfolio. When our risk index said we're risk averse, then we trade a totally different portfolio. And when the index said we're risk neutral, we trade yet a third different portfolio. So that
actually,
change,
Marc, that makes sense to me. So just to put you into perspective, just so the listeners that follow me, that they know I'm a trend follower. And what you're talking about is you're harvesting opportunities from the entire distribution through a mechanism that basically assesses the regime to identify how to dynamically allocate to different strategies, not necessarily trend following, but your quant, your short-term models, long-term models, to dynamically adjust to take opportunities from the entire distribution. In certain periods, the distribution is focused around the equilibrium. In other periods, it's focused towards the tails. And what you're doing is taking the best opportunity from all of that with your dynamic assessment.
Think of it this way. Let's say, within our 3 sub-strategies, we had 75 different individual models. We take those 75 individual models and we rank their performance by risk environment. So in risk-seeking environment, what is the best performer to the worst performer? Then we take those models and we rank the same way their performance in risk-averse environment. Best performer to the worst performer. And then we take the top performers in risk-seeking environment and we use them in risk-seeking environments. And so we increase the allocation to them and we decrease it to the allocation of the models that we don't use. And then in risk-averse environments, we do the opposite. In risk-neutral environments, we just stop at the halfway point.
Tell me, is how accurate, one of the things that always catches me by surprise is the unpredictability of the markets and how they can flip regimes really quickly. So with your models that are saying at this point in time, you should be risk seeking, if there is an event that suddenly comes in where you are dynamically heavily concentrated towards risk-seeking elements of your portfolio, does that give you a negative skew event?
No, because that's a great question. I'll tell you why not. So, I kept hearing the argument that CTAs are long volatility, which personally I don't believe to be the case. I think at best CTAs are long gamma, but that's an entirely different story. So actually in 2005, I ended up writing a paper proving that long-term trend following is not a long volatility strategy. That paper was republished in the Journal of Alternative Investments and won the Best Paper Award by Institutional Investor. Now, I think we've put to bed the idea that CTAs are long vol, but that shouldn't take anything away from why you should have a CTA in your portfolio. Because when you look at CTA returns through the risk-seeking and risk-averse environment, you notice that CTAs are actually one of the very few strategies out there that is almost agnostic to the risk environment. CTAs can make money in both.
It's uncorrelated to the risk environment.
Exactly. So, what CTAs need to make money, they need trends. And trends can happen in risk-seeking environment and risk-averse environment. But to go back to your question, so the paper I wrote about long-term trend following not being a long volatility strategy was for me more of an academic exercise. I mean, we were never long-term trend followers. It's something.
Did you get much pushback from that from industry?
No. I mean, look, it was a very well-written paper, and it was republished.
They couldn't argue.
They couldn't argue with it. I mean, and they don't need it because they're very unique in other ways.
And these papers are available on your website now, aren't they?
Yes, they are. Now, there was another finding that we had that actually I didn't write about it until 2009, but we had been using it throughout this whole period, and that had the most effect on the way we manage our portfolio. But so let me sort of explain it. So your question, Rich, goes back to this skewness, right? So risk aversion can hit you in one of two ways. It can either be an endogenous event or it could be an exogenous event. So we all agree that in an endogenous event, information comes to you slowly over time, that your models are able to take in all that information, and then by the time the event happens, you're positioned the right way, and it's everything is great. But what about an exogenous event? So take September 11th, for example. A dark day that hopefully will never be repeated, but let's take that kind of event. Well, that actually gives us a very interesting. So that's the perfect example of an exogenous event. Now, CTAs made money in September 11th, but CTAs made money in September 11th because they were already short equities and long bonds. And when the event
they just happened to be positioned that way.
Exactly, it pushed it in the same. So if September 11th, 2001 had happened September 11th, 2000, and they were positioned the opposite, they would have gotten destroyed. However, but let's go back to what we do, short-term space. So, and I'll explain. I'll sort of in this paper that I wrote. So I wrote this in a paper that I published in 2008. That paper was actually republished verbatim in a book by Risk Books in London, in one of their books in 2009. And in that paper, I was able to prove the following, which is that at the onset of an exogenous risk-averse event, the correlation between pure long volatility strategies and very, very short-term trend following strategies spikes to 1, stays very highly elevated until the effect of that risk aversion starts dissipating and going away, at which point the correlation starts dissipating and going away. So very, very short-term trend following strategies have this hybrid characteristic where they are long vol when you want them to be long vol and not long vol when you don't want them to be long vol. Now, what's the catch? The catch is, as I had proven in the paper I wrote about alternative data using CTAs as a case study, that while it's very easy to do medium and long-term trend following with simple alternative data strategies, when it comes to very short-term trend following strategies, you can only do very short-term with very, very high alpha strategies because otherwise they lose money. So if you have the ability or the capacity to build these very high alpha short-term trend following models, then they act as your bridge in these to keep that positive skew for you in the case of these exogenous risk-averse events.
So just so I've got it clear, so in the short, sharp corrections, you want these long vol, short-term components of this strategy. You've already got your medium to long-term components as well with another program. So what you're doing is you are capitalizing on all forms of divergence, effectively trying to get a balance across that divergence.
And frankly, to be fair, okay, so knowing this, whenever whether we have a risk-seeking portfolio or a risk-averse portfolio, we always keep some powder dry for that exogenous risk-averse event. So if I didn't impose on Conquest the mandate of outperforming in risk-averse environment, I can end up with a better overall portfolio. If I take that off the table, I can deliver a better Sharpe ratio and Sortino ratio in the portfolio. However, we pay that cost to give us extra ability to generate high returns in the risk-averse environment. So our portfolio, even in risk-seeking environment, is always tilting a little bit long vol.
Marc, is there a chart, like I've seen your long-term track record from 1999, it's very impressive. And look, when I look at it, it's clearly uncorrelated to trend following. It's uncorrelated to everything I've seen. Is there somewhere we can take our viewers to if they want to look at that long-term track record?
Well, we can't put it on our website for CFTC reasons, but it has. Your viewers are certainly free to contact me, and maybe you can put my contact information, and I'll be happy to send it to them. We just cannot put track records on a public domain.
It's a bit easier over here in Australia. It's we're not caught by quite the same
here
regulations as you guys. Anyway,
Okay,
sorry to interrupt.
That's great. Can I ask that question from a slightly different angle, Marc, that Rich has asked, I guess? So in any sense, when we're changing what we're doing with the regime change, what interests me is what defines the regime. So could you maybe talk a little bit to how you've constructed that risk index and what does define a risk-seeking environment or a risk-averse environment?
So let me start by saying that as proud as I am about the Conquest Risk Index, and our Conquest Risk Index was published daily on Bloomberg between 2005 and 2019, that's not the secret sauce. So actually in 2011, so when we built our risk index, there were no other risk indices out there. So obviously we use our own risk index because it's our own, gives us granular level, visibility on the data and all of that. By 2007, 2008, Goldman had its own risk index, Citibank had its own risk index, Deutsche Bank had its own risk index. So by 2011, we actually took all the analysis we had done using the Conquest Risk Index, and we substituted the Deutsche Bank index, Goldman index, and Citi index for the Conquest Risk Index, and the results are the same. So the special sauce is not in the index, because ultimately, one can be a little bit faster or not, but when you talk about risk aversion, you either have it or you don't. It's very clear when you have it, and every index is going to capture it or not capture it. The rest become minutia. The way we build our risk index is I said, look, what are the different risks that people associate with the market? Well, you have liquidity risk. So we find a proxy to measure liquidity risk. In our first iteration of the risk index, we used swap spreads. You have credit risk. How can you measure credit risk? We used, again, everything I tell you is the first iteration of our risk index. Now it uses something much more sort of, thinking better. But we use corporate spreads. You have foreign exchange risk. So we constructed a basket of currencies and look at the implied vols on that basket. You have equity risk. For equity risk, we use the VIX. You have emerging market risk. For emerging markets, we used emerging market bond spreads. And then, so think of it this way. So on a daily basis, we go and measure each one of those risks. And the risk index has to have enough degrees of freedom. So you cannot you cannot have a number for each one of those components, whether risk seeking or risk averse, because whether you are risk seeking or risk averse depends what you're coming from. So our index determines of each component. So it looks at each component and measures whether each component is risk seeking or risk averse. And the way it measures it for each component, it looks at where it is relative to its recent past. Is the risk elevated or not? If it's elevated beyond a certain level, then it becomes risk averse. Otherwise, it's not. And if two of the 5 components are risk averse, the index becomes risk averse. Otherwise, it's risk seeking. Now, why did we choose 2 as that threshold? Is because we noticed that anytime you look at those 5 different components, chances are one of them is exhibiting signs of risk aversion. But if one of them is exhibiting signs of risk aversion, the contagion probability of any other of the 4 becoming risk averse is very low. However, once that risk aversion goes from one silo to the second one, then the probability of a third and a fourth and a fifth becoming risk averse becomes extremely high. So to put it another way, as long as the contagion is in one silo, you're safe. You're still risk seeking. But the minute that contagion spreads from one silo to the second one, then the risk of complete contagion goes up dramatically.
Was it a lot of effort? Did you have to backtest this? Did you have to gather this data in order to make it something you could put into your backtesting engine to run along your...
Not really backtest, but I mean, obviously it took a lot of thinking about how to structure it. And then when we came up with it, backtesting doesn't really help because then you're restricting the degrees of freedom. So what we said, okay, well, given the way we have defined this risk environment through our risk index, then let's see if markets and strategies display any statistically significant difference in their performance. So there was no backfitting. There was a lot of work on coming up with what we think is the best risk out version of the risk index. Then we took that risk index and saw if markets, show any statistically significant difference in their performance relative to this index. Now, look, so when we first added this risk index to the Conquest portfolio in 2005, we had 3 individual sub-strategies. But if you think about it, Conquest from day one was built with models designed to do really well in risk-averse environment. So, the way we achieved that 25% improvement on a risk-adjusted basis by going from a static risk allocation to a dynamic risk allocation was essentially by taking risk away, in risk-seeking environment, taking risk away from our worst-performing models and giving it to the less bad models. Because we didn't really have anything that was designed to do really so. So the next phase in our research, once we went from static risk allocation to dynamic risk allocation, next challenge was to see if we can actually build a 4th sub-strategy from scratch, but one that was designed from the ground up to actually do really well and have positive PNL in risk-seeking environment, where we can add more risk to it in risk-seeking environment to generate positive PNL, not just lose less. We did that by 2007 and added a 4th sub-strategy. Now, that 4th sub-strategy, when we added it, if you looked at it on a standalone basis, it had a correlation of about 80% to the HFRI with better risk-adjusted return. So it looked very much like what a good long risk strategy would look at. So essentially, that gave us an extra place to go to in the risk-seeking environment that will give us positive P&L. So we added this at the end of 06. 07, we were up about 30% in its first full year into the portfolio. 2008, we were up around 45%. Now, our performance in 2008 landed me on the cover of the New York Times as one of the top performing global hedge fund manager. But to tell you the truth, the real gratification for me came in being able to prove that, yes, we can take what started off as a crisis alpha plus strategy and turn it into an all-weather strategy, which we did when we added this 4th sub-strategy in 2007, and still have the ability to generate the outsized type returns in risk-averse environment like we did in 2008. So that's when I think we progressed from a crisis alpha strategy to a true all-weather strategy with a crisis alpha component.
And Marc, so clearly there's a bit of timing going on here. You think that this model that you've got is timing the regimes well?
Yeah, but look, I mean, anytime you're looking at any data series, there is an inherent error rate in that data series. And this is where, and again, to bring back your point about exogenous risk event, and this is where, I allow us to have not a worse portfolio, but whether we are risk seeking or risk averse, I always want us to have that long vol component, just in case our timing is wrong and we are in a risk seeking environment where in reality it should be a risk averse environment, and a risk averse happen, we're still able to deliver highly. And in reality, if you go back to our performance since we started, on a daily basis, which we can make available to you if you like, you can see that our capture rate for any risk-averse event really goes down to that day that same event happened. So think of it this way: we are always long vol, quote unquote, but when the risk index becomes, let's say, risk-averse, then the heavy ammunition comes in, but we always have some exposure to the market to be on the long vol side.
Yeah, so I wanted to ask a cheeky question, which is, what's the relative increase in performance when you are running this timing versus if you ran all your strategies all the time?
Look, we measure this fairly carefully, and we think we can improve anywhere from 25 to 40% by doing the different timings. Let's say 25% risk adjusted to be on the conservative side.
And tell me, Mark, what's your preferred measure of risk metric? Like, I'm not a big fan of Sharp, but what are you looking at in terms of your performance?
Well, look, I mean, the Sharp is a perfectly good measure of risk, except that, look, so historically, we've always had a ratio of upside vol to downside vol of 1.6 to 1. On a going forward,
so Sharp's going to penalize you for
exactly,
that, isn't it?
Now, in managing money for 22 years, I've never had an investor call me up and complain that our upside vol was too high. Investors are usually very worried about downside vol. Now, unfortunately, Sharp ratio treats both upside vol and downside vol the same. In that capacity, it is somewhat limited at measuring. So things like Sortino, I think, are better ways to look at, or even maybe a Kalmar ratio. But Sharp ratios don't give you the full picture when it comes to long vol type strategy or strategy where the upside vol is drastically different than the downside vol.
Yeah. Yeah, it puts you on an unfair playing field when you're using Sharp to compare and contrast strategies. So I mean, those particular strategies that...
rule of thumb is very simple. If upside vol and downside vol are the same, Sharp is a perfectly good measure. If downside vol and upside vol are sharply different, then Sharp doesn't really work.
So tell me, Mark, look, here's a slight pivot here, but I notice that you've basically been very interested in replication strategies for a long period of time, long before the CTA replication was quite well known. For instance, today we've got, DBMF with Andrew Beer. We've got newfound research now with Corey Hofstein all going into this area of replication. But I see that you were involved in this area a long time ago. Can you talk about this?
Sure. Well, look, back in 2001, while I was doing research on our own alpha models and alpha strategies, I came to the conclusion that a majority of hedge funds out there are not really selling alpha. They're selling what I called at the time exotic beta or alternative beta and selling it as alpha. Now, my point, I eventually wrote a paper about this, and my point in the paper was not that these alternative betas are not important, quite the opposite. When you looked at these alternative betas, they were by and large not correlated to traditional investments. They had a positive expectancy. So they definitely had a place in virtually every portfolio. I just didn't think they should be priced at 2 and 20. And as a case study in my paper, I used trend following CTAs, where I showed how if you take off-the-shelf trend following indicators and apply them to a diversified set of markets and a diversified set of time frames, and you don't charge 2 and 20, in the long run, you end up with the returns that beat the majority of CTAs. Now, I published that paper in 2002, not really thinking too much about it, thought it was just something interesting worth sharing. I can't tell you the amount of hate mail that I got.
I can imagine.
You can imagine. But I can tell you today, 22 years after publishing, 21, 22 years after publishing that paper, that some of my most vocal critics back in 2002 are offering their own alternative beta CTAs. So I feel somewhat vindicated on that front. But the interesting part is that in 2004, so I wrote this paper in 2002, I published it, got all the hate email, but forgot about it because really we're short-term, we're doing very short-term trading. That wasn't our space. And then in 2004, I get a cold call from somebody saying, look, this is so-and-so. I'm the head of the Columbia University Endowment in New York. I read your paper on alternative beta. This is what I've always suspected to be the case. And asked me if we would take $50 million from Columbia University to start the first fund dedicated to the idea of alternative beta. So in a way, we were both the thought leader as well as the product leader behind alternative beta. So our alternative beta CTA, we started that fund in 2004 for Columbia, and then we had a few other clients into it. And then in 2007, we came up with long risk alternative beta. So call it a generalized hedge fund alternative beta. In 2010, AQR comes into the market with, believe it or not, one trend following alternative beta and one long risk alternative beta that, from a correlation perspective, were fairly highly correlated to the two products that we had in 04 and 07. But unfortunately for AQR, not as good results. But AQR, being the marketing machine that it is, they managed to raise, I think, $30 or $40 billion in like 40 years for those two products. But in a way, I give AQR credit for bringing alternative beta to the outside to the outside world. But unfortunately, they did it with two inferior products that it gave alternative beta a bad name. And I think with Andrew now and some of the other people coming in with their own version of alternative beta, that space is getting the recognition that sort of it needs.
Interesting that I noticed that Andrew is using, I think, 14 markets to replicate the SocGen CTA index. And when I was listening to Corey Hofstein with Newfound, I think they're using both a top-down approach with markets and a bottom-up approach with strategies for their replication approach. Without giving the secret sauce away, can you tell us about your method of replication, what you were doing there?
I'll give you the secret sauce. I wrote about it. So look, when you're building a CTA, there are a few points you have to get. So, when I think of long-term trend following returns, I think there really are two factors that explain 95, if not 99% of CTA returns. And those two factors are what market mix you have and what time frame you are. Now, in terms of market mix, I didn't want to impose my own bias on what market mix we use in our replication fund strategy. So I did a survey at the time of the 20 largest CTAs, and I took an average of what markets they trade in what proportion. That gave me about 55 different markets that, when you look at them, it looks like any CTA that you've looked at, any trend following secret, commodities, FX, all that. Then became the question of the time frame. So here it got much more interesting. So when you look at CTAs in general, they tend to be long-term trend followers. So first, for me, like one of the questions that I needed to answer is, what technique do I want to use for my trend following? So there are many different techniques you can use. You can use moving averages. You can use breakout strategy. I always found breakout strategies to be mathematically more elegant. And the way we define, let's say call it an end-day breakout strategy, the way we define that end-day breakout strategy, it's always in the market long or short. So let's say you're long, you stay long until you make an end-day low, at which point you flip from a long to a short. Then you stay short until you make an end day high. You flip from a short to a long. Now, so we have our 55 different markets.
Some of us are out of the market, though, with those models. So we have a flat, long or short.
No, it's always long or short.
Okay.
So then we took, those end day strategy, and we took for end going from 1 to 200 and ran 200 different portfolios. So think of it from let's say 2-day trend following to 200-day trend following. Then we looked at the correlation of all those 200 different strategies to the CTA space. Now, before we looked at the correlation, we looked at the returns. So when you look at these 200 different breakout strategies, you see that the best performing breakout in terms of risk-adjusted return is that kind of 70-day breakout. Now, the relationship between the end-day breakout and holding period, so the holding period of an end-day breakout strategy is 1.5N. So a 60-day breakout strategy will have a holding period of 90 days. So when we looked at just the breakout strategy, the best breakout strategy was around that 70-day. Then if you go back and look at the CTA space, whether you're looking at the indices or the individual trend followers, you see that they all show their highest correlation to a 70-day breakout. So, these guys are fairly smart. If they're doing, alternative beta, they're at least picking the best performing one. However, when we looked at those 200 different breakout strategies, we noticed that while the best performing ones are the medium to long-term ones, the very short-term breakout strategies have this long volatility characteristic that I spoke about earlier. So Columbia, the head of the Columbia University Endowment, wanted to be very present in the design of this product for them. So when we took our findings to him, and I said, look, if you're looking for a product that has the best risk-adjusted return, I suggest we do only medium and long-term trend following. And that gives you the highest correlation to the CTA space and the best return. However, I feel compelled to share with you the long volatility profile of the shorter term breakout, but those have negative, if you add them, it'll make the performance of the product less. And he looked at me and he said, look, 99% of my portfolio is in long risk strategy. I don't mind if my CTA allocation underperforms in the risk-seeking environments when 99% of my portfolio is doing really well and outperforms at the time when everybody else is doing that. So actually for the product that we created for Columbia University, we created all different time frames. So we ended up choosing 20 out of these 200 breakouts that gave us a much more we stayed at the curve of sort of the optimal frontier when if you think about it, like the 20 most representative out of the 200 that traded that portfolio.
Interesting. Thanks for that.
Awesome. I guess we should start to point towards the finish line slowly but surely. No rush. This is a fantastic conversation. Marc, can I, as we angle back toward your strategies, I suppose, and we really come to the edge that Conquest has, I probably haven't picked up super clearly yet whether there is any or much long-term trading going on. So can you just talk to the balance of short-term, long-term?
We don't do long-term. We're strictly short-term. The longest part of what we do is our, call it that risk capture, the fourth sub-strategy we added, the one that we hide more risk in, let's say, risk-seeking environment. So our research for the last 10 years has been kind of in a couple of different directions. So one direction is our work on the risk environment and our capture of that risk environment. Another direction, so one way that we evolved over time, I said, look, when I first started building quant models, I had very much of an ultra-orthodox approach to it. So I wanted every model that I had to trade every market the same way. If it didn't do that, then I didn't want it. That was my own way of making sure I avoid the path of overfitting. As you do this, year after year, decade after decade, and you learn more about what you're doing, you start noticing that different sectors they trade differently. So when I look at FX as an asset class, there are certain type of models that work in FX that might not work in fixed income, or one that work in equities that might not work in FX. So we started branching out into what we call these quant macro models, where we take, and so when we first started building models, we were only using price data. So as we evolved over time, we started using fundamental data, we started using cross-market data, we started creating models that were based for an asset class and not an individual thing. So this really sets us apart, I think, from the majority of our peer group. But also, I think fundamentally, sort of, we have a different approach to model building. So from day one, we've had this unspoken rule in our quant group that if you can't explain your model in plain English to a reasonably intelligent person and have them understand it in about 5 minutes or less, then we don't want it. What that means is that none of the models that we have, think of it this way. There are a couple of ways of building quant models. So you can feed giant data series into very powerful computers and see what worked in the past and trading that. And many people do that, and they do it well. That's not what we do, because primarily, if I don't know the reason for the alpha behind the model, I wouldn't know when it starts, when it's supposed to work, and I don't know when it's not supposed to work. So I won't be able to manage it. So for us, and I think this is partly due to my own background, being a mix of both quant and running some of the largest prop and discretionary trading businesses in the world, we come from a different approach. For me, in my head, the divide between discretionary trading and systematic trading is almost not there, because I know many discretionary traders, from George Soros to Julian Robertson to Stan Druckenmiller. I mean, these guys, when you ask them about some of their best trade, they don't tell you. They didn't wake up one day and just decided to do this trade. They had if A happens, then B happens. If A and B and C happen, then I'm going to do this trade. When I enter into this trade, my objective is this. If it goes to here, then I stop out. I'm wrong. To me, that's
very rules-based and very systematic in its own way.
To me, that's if you have a strategy, then that strategy, then you can put it into an algorithm. And if you put it into an algorithm, then you can backtest it and see how it works. So for us, every model that we have is based either on macroeconomic theory, on behavioral theory, and psychological theory. We know what the alpha is there. We know when it's supposed to work. We know when it's not supposed to. And it gives us, I think, a totally different profile than our peer group.
Yeah. No, that's great, Marc. Like what's grabbing me is that you're very diverse. You're attacking a lot of different edges. It's not strictly trend. There's a lot of now, different approaches. You're uniquely positioning yourself, and you've got a great track record. And all of these strategies are coming together with a really powerful risk-adjusted return over the long term.
Thank you very much, Rich. Appreciate it.
One other question, Marc, just individual equities, would they or could they ever feature in your trading models?
They could. We're looking at some. We're not there yet. Next month, we'll be adding, Bitcoins to our portfolio. So we're branching out slowly.
Got to get a piece of that.
We're branching out slowly. Look, we're nowhere close to adding individual equities, but obviously it's an area of interest in our research.
Is that quite a regulatory hurdle in the US too when you cross that divide, or is it just the technological?
Absolutely, because you go from being regulated by the CFTC to being regulated by the SEC, and you have to file with the SEC, and then it becomes a whole different procedure.
Awesome. Yep.
Marc, just quickly, how do you prevent overfitting with your models? Is there any process you adopt?
Absolutely. You do the typical things that all the rules. You do your analysis on half the data, then you run it forward on the other half. You do all these kind of things. But look, at the end of the day, it really comes to how you build your model. If you start with an observation in the market, and then you're putting that observation in an algorithm to see if it works or not, and then fixing at the edges a little bit, I think the chance of overfitting becomes very less, because it either works or it doesn't work. If you go and look for patterns that worked in the past and you have no idea why they work or not, then ultimately the overfitting risk becomes much higher.
Yep. No, that's exactly right. I find that with these engines you put your models into these days, if you don't have any clear design statement that this is the edge I want to attack, and you'll let it achieve its own outcome, you get these massively overfit models at the end of it. So I love your approach, your design-led approach. You've got an idea. It's a scientific approach. You have a hypothesis. You put it into the market environment. You tested a hypothesis. You might do some weak sort of manipulation around the edges, but the core design and the philosophy is your scientific hypothesis, basically, which you test. So I love that idea.
Exactly.
And just as we're starting to wrap up, just that process, Mark, of wrapping up, let's say 100 individual, smaller, simpler models into larger macro strategies, or those 4 strategy groups you talk about. What's the process there? Is it just one of having, fairly simple models where you do try to keep it simple, and then your complexity comes in then how you're aggregating those into larger strategies?
Absolutely. I mean, look, your individual models cannot be too complex, because too complex, too many inputs, the risk of overfitting becomes much higher. You want your models to have as many degrees of freedom as possible, and you want your models to be capturing a naturally occurring market phenomenon. If it's capturing a naturally occurring market phenomenon, then you're really just kind of jumping on that ride at some point, and then you're getting off when you're not trying to force, any outcome or anything like that.
Yeah, and then is there some additional complexity in how they accumulate, or it's really just a matter of bringing them all together, running them all under a single banner for a particular strategy?
Well, look, so, you don't start with 200 different strategies, right? So you start with the core that you started with. And then each new strategy becomes an incremental addition to what you're doing. So you decide, how much risk you want to give to this, let's say, this new model that you add. Well, what is, in which sub-strategy is it going? What its correlation to the different models that you already have? Is it trading all the same market, is offering different markets? So it's overwhelming when you think of, over our history, we've built over 200 individual trading models. So if I had to take all those 200 models and put them together today, it's sort of a bit of an overwhelming, job. But when it happens naturally over time, then you're always, trying to kind of fill the gaps where they exist, and just you add risk here, you take a little bit there, and then kind of keep, building your portfolio.
Right.
Mark, views on diversification? How far should we go with diversification? What's your view there?
You mean within our own strategy, or?
Well, there's a lot of arguments regarding, this viewpoint that diversification benefits decrease at a certain point in time. You reach a marginal threshold.
Yeah, I mean, look,
square root of n, all of that sort of stuff.
Absolutely. I mean, look, it's a new thing now for a lot of the CTAs to be trading 200 markets or so. It looks great from a marketing perspective, but once you're managing $1 billion over, and you look at the profit attribution or the risk attribution, right? So even you take any CTAs that's trading, 100 different markets, you will see that probably 70 or 80% of the risk is coming from a much smaller core of market that every CTA trades. So it would sound good, I can add 30 different markets tomorrow and give each one, a tenth of a risk allocation or something. And I would be trading, 60 instead of 40, let's say. But the effect on my portfolio will be almost minimal. So sometimes there are the addition of markets for cosmetic reasons, and sometimes there are addition of markets for real risk reasons. I think by and large, most of the risk in the transforming space today is still being taken by the core, global fixed income, the deep market that you can employ that much money in. The G10 FX, the global government fixed income, the large equity indices. You can trade a lot more markets, but you're limited in how much risk you can put in them.
It sounds like you've got a greater sort of perspective of diversification towards system diversification as opposed to market diversification. Is that right?
Exactly. I mean, look, at the end of the day, a lot of these markets tend to be very correlated to each other. So, you might add them if you want to create some more capacity at the margin. It might help a little bit, but you get a lot more diversification from model diversification, strategy diversification that you get from market diversification. At least it's been our experience.
A couple of final questions from me, Marc. Do you do anything on the intraday level with intraday data? Is it that short term, or
we don't? We have a little bit, but it's not a major part of what we do. It's something that we're looking at.
And then I just wanted to clarify the strategies that you talked about, or strategy that was non-trend or slightly different. Is that still a, I guess, breakout / trend kind of thesis, or is there something mean reversion or something completely different going on there?
No. Look, we're in that sub-strategy, we're going long and short risk premium. So when we added it in 2007, it was primarily a static long risk premium. So it had that 80% correlation to the HFRI. If you look at that sub-strategy today, it has better risk-adjusted return, but 30% correlation to the HFRI. And there we're trying to capture, equity risk premium, fixed income risk premium, some commodity, the currencies.
Got it. Okay. Rich, do you have anything to finish on before we wrap up?
I think I've run out of questions, Marc. Thank you very much for this.
That's awesome.
Thank you,
Marc,
guys.
did we miss anything that you'd like to cover? Anything that we've missed?
No, I think we covered pretty much everything. I mean, we're kicking off our fundraising campaign for our onshore and offshore funds. So we're out there talking to clients and hoping to grow our business.
Awesome. So if someone does want to get in contact with you or read those papers, where should we send them?
They can go to our website, www.conquestcp.com. They can see the papers there, and there is my contact information if they would like to get, performance data or anything else. We have a fairly extensive data room that, investors can dive into.
Fantastic. All right. Well, let's leave it there. Thanks so much once again, Marc. We really appreciate it.
Thank you very much, guys. I really appreciate it.
We should remind you that the conversations on this show are informal and for entertainment purposes only. Certainly any general advice you may hear is obviously not specific to your needs, goals, or objectives, so nothing discussed on the show should be considered as investment advice. If you want that, you'll need to actually do your own research and speak with your financial advisor. Remember, trading can be extremely risky and past performance is not necessarily indicative of future returns. If you enjoyed the show, please subscribe or leave us a review, and if you have any questions or feedback, we'd love to hear from you. Bye for now.